Hey everybody, it's Saturday, April 6th, 2019, taking a look at the S&P 500. And I wanted to make the subject of this video, aside from looking at what we need to trade next week, but talking about what you see when a top is formed in the market. And because there's a lot of people out there this week calling for a top that we're seeing the 2019 high, that we're seeing the high for the next year. And I just want to show you where we're at right now in comparison to all the other tops, interim tops or big tops that we've seen in the market. And when we look here through what happened in 2018, this was probably one of the few times that you ever saw a true top just be made and we fell off of a cliff. This was, a huge running leg that we made into the high at the interim high for 2018 at 28.72. Not far off from where we are now. We're trading about 20 points above this. And what happened with this was we had a gap down open and we rolled over from there. And this is the setup that everybody is trying to point to right now. This, I think, was had a set of circumstances around it that were unique onto their own. And the key circumstance was this right here. This was Janet Yellen's final Fed meeting as chair, right here on the 31st of January in 2018. And from there on out, the market knew that they did not have the same Federal Reserve chairman, and that was it. So that was a huge catalyst. That was a huge factor that started us off. And what we saw from there on out for the rest of 2018 was, once we made our lows, we would make these little V formations. We would come up, and if we couldn't take out the previous high, then we would roll over and make another little V formation. Okay, and even when we did take out the previous high, we would come down and we would make a little V formation. And all of this consisted of always had to do with intermingling with the simple moving averages, but you always saw this little V formation and then this trade out. Okay, so we did not have that V formation here at the start of 2018, but what we did have was some intermingling with the 10 and the 20-day simple moving average. And when I look in more closely here, you can see that we moved up, we made our interim high, and then we gapped down open, and that gap down open struggled to hold on to the 10-day simple moving average and looked below it. Came up, could not put in a close back above the 10-day simple moving average, and then it moved on, and then we broke the 20-day, and then we broke the 50-day, and so on and so forth. Okay? And then when we look to what was going on all last summer, we would constantly see these little V-shaped formations where we would come down and we would intermingle with the simple moving averages, but we always found buyers. And we would come up and we would take out the previous high, move on, make a little V formation, testing once again into these simple moving averages and on out. And what wound up happening for us at the actual all-time high that was set in September, we came in right after a little V formation that was happening at the end of a quarter. We couldn't quite take out the previous high, so we did it by gapping up open. The next day we printed our all-time high, our new all-time high, but we did not make a higher closing high. That was clue one, not making that higher closing high. Clue two was a gap down open, and then a few days later, a move down below the 10-day simple moving average. That move down below the 10-day simple moving average coincided with the Fed meeting. I know that because I put an arrow on top of all those Fed meeting days. Fed meetings, Fed minutes, non-farm payrolls day, and if there is some kind of really big pivotal speech like the State of the Union address coming that night, or the Jackson Hole speech that comes on in August or whatever. I always mark those with an arrow, and I look to see a pattern of behavior that happens around it. And you can see here the pattern of behavior that happened around this Fed meeting. So this was our break of the 10-day and hold above the 20-day. We came up here, we made our little V formation around this Fed meeting. We came up and we made our lower high. We could not take out the previous all-time high. And at this point, we were starting into Q4. So this was the end of Q3. Here was the start of Q4. And then from here on out, we rolled over into some much bigger, more volatile days, breaking the 10 and the 20-day on a closing basis in a single day. We hadn't done anything like this in months. Followed the next day by the breakdown and the look below the 50-day. This was a non-farm payroll day. This is the day that we're kind of shooting against right now. We're trading right against the levels that we traded in this day here. Then we had a couple days of consolidation where we tried to hold on to the 50-day simple moving average, and then we broke down with a gap down open below the 50-day. That was the big pivotal event that started the final blow here for the sell-off on Q4, and this huge down day on the 10th of October. This is a day that we have been trading against for weeks and weeks now. Okay, so let's take a look at where we're at now. Okay, throughout the course of 2019, okay, we do have our V formation here at the low at the end of the year, and we've come in and we made a little V here, consolidation, and move up. But once again, once we make an interim high, we make a little V formation. We intermingle a little bit with the 10 and the 20-day, and in this case the 50-day, because this sell-off got our simple moving averages all restacked from high to low instead of from low to high time frame, which is bearish. We want, in a bullish environment, we want them stacked 10, 20, 50, 100-day, 200-day in nice orderly fashion like that. And by the time we got to the end of December, they were all backwards, as you can see here. So here was a little V formation, taking out the previous high, moving up to a new high, making a little V formation, taking out the previous high, so on and so forth. And this goes on and on and on. And our last one, our most recent one, was this V formation made as we ended Q1. Our last big volatile day being here on March 27th. This was Wednesday, Thursday, and then we gapped up, open here on Friday, the final trading day of Q1. We had been stuck between the 10 and the 20-day simple moving average. We gapped up open out of this, and we've traded into our current leg, which ends here with our non-farm payroll day. And what everybody is thinking and saying is that this is a lot like 2018. Only it's not a lot like 2018, because in 2018 we only had the leg the first month and then we rolled over. We've gone a whole leg of an entire quarter, to the point of where we've pulled our 50-day simple moving average back up through our 200-day simple moving average. We have Fed minutes coming our way this week. That might be a situation where we just make a little V formation once again, sitting and waiting before we take off higher. Or we could be looking at the start of a leg that's going to take us quite a few more points higher, right into those Fed minutes on Wednesday. Then we digest and consolidate for maybe a little bit longer period of time, maybe like a week and a half, as we get through the holiday week that we see in April week 3, the week after next. Okay, so right now, if we are in the pattern where we're just going to fall off the cliff like we did in January of 2018, we would have to see a gap down open on Monday, and we would have to see follow through and a breakdown below the 10-day simple moving average at minimum. Are we really going to sell off that many points? Make a candle like this one that we saw here on the 22nd? No, I don't think so. I don't think that we have the firepower for that right now. Right now, also, we are really obeying this 80 handle rule. I think that, if we fail right now, if we make a little bit higher high on Monday, but then don't make the higher closing high, I think maybe, we trade back down to 28.80, fill this gap to Thursday, and obey this gap that we just filled going all the way back to October 9th at 28.80. Maybe consolidate for a couple of days, make that V formation, see what those Fed minutes say, find out from that there's, definitely nothing to be worried about. And then we move on from there. We make another little bit higher high. And then as we get into next week, we face a holiday weekend. Most of the world market is closed on Friday of April week 3 because it's Good Friday, and most of the European markets are all closed. The Asian markets will be open, but the European markets will be closed. So chances are, we will have like an interim event around that. If we start selling off, I bet that we will bottom out ahead of that. If we keep rallying, then I think maybe we'll sell off a little bit into that. And based on the option structure, as I was tweeting about on Thursday and Friday of this week, I thought that I saw a lot of activity that looked like people were rolling out of rolling out of next week's expiration 28.55 puts, either rolling out of them or selling them short, and buying 28.50 and 28.60 puts for April week 3. So I kind of feel like we've got a little bit more of a high coming next week, and then as we get into April week 3, maybe we come down into that V formation and consolidate for a while. And then when we come back from Easter, maybe then we start another leg up as we get towards May. Okay, so I hope that this helped you out in understanding, the formation of tops and so forth. Let me just talk through these last upside levels here that are on the roadmap here. Then we made it to, these are a couple targets that I put on here to go into Friday with for non-farm payrolls day. Target 1 was going to be the high from October 9th. So we came just about to that target and backed off. 28.94.83 was the target. Our high came to 28.93.24. So about a point off from that. And then our closing high is at 28.92. If we break out over this, obviously we face 2,900. There's a lot of money rolling into calls for next week at 2,900 on up through 29.25. So that too, if that is true, call traffic in there, if that's just, overzealous retail, that's another story. But if that's real money going in there, then perhaps what we're looking at is at least this move up here to 29.10 to 29.11 or so. Here's a measured move level that I put on the chart. This would be a doubling up of this stuff that happened back here throughout Q1. We came up to this 28.17 level and failed at 28.17 is rounding up the bounce high from Q4 of 2018. We got up to a high of 28.16, 90 something, and backed off from there. And we tried to take it out like 3 times in Q4 and couldn't take it out. And then here we were coming right up to it in Q1 of 2019, finally taking it out here, but falling back, taking it out here and falling back in. And it wasn't until that final trading day of Q1 that we completely broke away out of this level. And so I see that as a very major breakout point. Maybe eventually we're going to come back down and trade to that. But for now, I think we're in the process of doubling up from that. And the double that I was thinking was from the March low to this breakout point at 28.17. That would take us here to 29.11.50. Okay, so if we get up to here, we've doubled the move from the March low to breaking out from underneath 28.17. If we move out above 29.11.50, then we have this final gap up above us. That's the last of the gaps from Q4 2018. Once we get through this final gap, then we shoot against the last 2 highs. The failed high that was made on October 3rd against the all-time high, and then above here is the all-time high itself. So this seems to me like a really good place to maybe take a rest. So I think there's a little bit more gas in the tank to get to here. And then maybe we get into a V formation thing where we wait on things, the V formations like I've shown you throughout the chart. And it would make a lot of sense to rest here and come back down and test 28.80. Fill in this gap, hold above this 28.80 level. This would also play out our 80 handle rule where we kind of took a look above 2,900. If we fail to hold above 2,900, then we come back and we test 28.80. If 28.80 fails, then we go to 28.60. 28.60 is right down here. At the high that we made in March. That's the Q1 high, it was 28.60. So We've got our 80 handle rule to help us remember where we're at. And then if we were to make a little bit higher high and then come down and make that V formation and consolidate for a while, that would help the 10-day simple moving average to catch up to us. And then once that catches up to us, maybe we push down a little lower, test that 10-day, and then bounce on out of there, because this is another sort of worrisome thing if you're bullish to see the market get this far out over the 10-day simple moving average. I mean, you usually never see this much space between where we're trading and where the 10-day is at. Usually something like this is followed by a little bit of a pullback or at least a sideways consolidation. But like I said, if there is just one more little gasp up here, it would make a lot of sense for it to find some sellers here just over 2,900 and then pull back a little bit. And I think the pullback will hold 28.80. And if it doesn't hold 28.80, I firmly believe it will hold 28.60. We will hold above the March high and consolidate and move on out and probably go after the all-time high from there. And if I'm wrong about that, great. We'll just buy some more puts and we'll make money and we'll trade it. And we'll work our way on down here to this 28.17 level and test that. But anyway, before I drone on and make this video too long, I'll stop it here and let you enjoy the rest of your weekend. And I'll see you Sunday night. As always, good luck and good trading.